Investment real estate. We've been talking in this series all about investment real estate. When we think about investment real estate, there's really two separate schools of thought. There's the one school of thought that says, I want to increase my cash flow today. I want more money in my pocket to supplement the income that I receive from my job. And to do that, when we acquire a property that's a rental property that receives rent, we want to amortize it over as long a period as possible, pay as little as possible off the mortgage, and have as much surplus as we can possibly have. And books like Rich Dad, Poor Dad espouse that philosophy. Generally speaking, people who follow that avenue aren't married to the property. They keep it for 5 or 6 years. They're going to spin it off and replace it with another property. And people who do that can make an awful lot of money doing that. But then there's the other school of thought, and the other school of thought is what we want to do is we want to pay these mortgages off, get these properties eventually free and clear so that we can enjoy the rent that comes in our retirement years. We want to enjoy it later, so it's deferred enjoyment. We are going to pay a price now and get a benefit later. So to do that, we want to acquire these properties with a plan in mind. And for over 30 years now, I've taught the Money Machine seminar with this basic principle in mind. Very, very simple plan. And the plan outlined is buy one property a year for 10 years, never amortize for more than 15 years, and never sell. And if you follow that simple plan, you will be in a position to retire with the properties paid off and lots of passive income coming in. Now, there's some challenges to this plan for sure, and I want to be honest about it always. I never want to oversell, underdeliver. So in following this plan, you've got the challenge of saving a down payment. And saving is hard. I think regardless of what your income level, you can do so because we spend at the level we earn, and we can tighten our belt, and we can find ways to save some money. And we need to do that. And in fact, in this simple plan, we need to do it multiple times, not just once. We need to save money for the first property, save money for the second property, on down for 10 properties. Now, it gets easier because there's equity being built up in these properties. There's the potential to refinance them, take some equity out. There's a lot of things, and we'll discuss those. It gets easier, but it still isn't easy. There's a challenge of saving the down payment. There is the fact that you're not just doing it once, you're going to do it 10 times in the simple plan. But then the third thing is taxes. And that's really what I want to talk about today is taxes. There's two things that will derail the simple plan of building up an investment portfolio for retirement. The one is a bad tenant. We've talked about how to screen tenants and how to best position yourself so you don't end up with bad tenants. The other one is taxes, and there's no avoidance of it, but there's some preparation we can make. I want to show you a chart in a minute that shows you the exposure you're going to have to the tax man. And this is based on the idea that you're buying one property a year for 10 years, that the acquisition cost of the property is $500,000 each, and that you're going in with 10% down or $50,000 down. So we take a look at the plan, and you'll see that the first year, the acquisition cost is $500,000, and it's going to be $450,000 mortgage and $50,000 equity you put in. So your equity increase is $50,000. That's not taxable. That's money you put in from your savings. There really is no tax right there. But over the course of that year, you're going to be making monthly payments on that mortgage, and each payment is going to be reducing the principal of the mortgage. And so you're gaining ground there. So your next year, you're going to put in another $50,000 equity, and you're going to be paying down, starting then, 2 properties. And each monthly payment is going to be reducing the principal of the mortgage on 2 properties every month. And so at the end of that second year, our increase is $67,739. Now, $50,000 of it is the down payment we put in, but in actual fact, that means $17,700 is profit that went to the bank to pay down the mortgage. And as you go year after year after year, as you add properties, you'll see that the amount of equity that growing is increasing substantially. And I want to caution you here that this doesn't take into consideration capital appreciation. Your properties will go up in value. Oh, there might be the odd dip from time to time, but over time, properties go up in value. Just look at what your parents paid for their first house. If you've owned property for any length of time, what you paid for your first house, they go up in value. But we're not even factoring that in. All we're factoring in is the amount of depreciation of the mortgage because of the payments you're making, and it's actually the tenants that are making them through year 7, 8, 9, 10. One of the key things is when you hit year number 10, and we take a look here, at year number 10, you'll see that the year-over-year increase is $263,562. Now, $50,000 of that was the down payment for the 10th property. And so in actual fact, the amount of profit that's shown here is $213,563. You don't see it, you can't spend it, the bank gets it, but it's profit. The next year, year 11, it drops a little bit because there isn't any down payment. You didn't put the $50,000 in. So when you took it year 11, it's $246,514. That's straight profit. It's not profit, as I say, you're going to see. It's profit that the bank gets, but it's profit. The next benchmark is year 16. And why 16 is important is because now one of the properties is paid off. You amortize them over 15 years. Year 16, now you only have 9 mortgages, not 10. And that continues on to year 25 when they're all paid off. But here's the reality. These huge numbers, 250, 260, you get down to year 16, 347 is a very substantial amount of money. But you don't get it. The bank gets it. But the problem is the government says, we don't care whether you spent it on yourself, whether you took trips and extravagantly spent money on cars, or whether you gave it to the bank. Either way, as far as we're concerned, it's earnings that you got to pay tax on. So you've got $300 and some odd thousand coming in from rent, and you got the bank with their hands out, and you got the feds with their hands out, and you got a problem. You've got to pay income tax. And what you have to do when you're filing your income tax return is you have to add that amount. If I look at year 16, you have to add $347,737 to your income and pay tax on it. And you can be sure that you're going to be in a 50+% income tax bracket that year. So you're going to have to come up with, $180,000 additional tax. How are you going to do it? It's a very, very real problem. It's one of the Achilles heels of this whole investment seminar. But there's things that you can do to mitigate the hit. One of the things is the fact, and it very much is a fact, that over time, rents increase. The government gives you a 2.8 or 3 or 2 or whatever, but you're also going to have times when the market rent's gone up beyond that. A tenant leaves, you rent it out again, and you rent it out at market rent, and it's a substantial increase. And over time, your total gross rent coming in will increase year by year by year. Your expenses, your mortgage expense is locked in, and that surplus can be used to give to the tax man. Also, at year 11, you don't need to save for income for down payment any longer. You've been tightening your belt, and somehow or other, you've come up with $50,000 a year as a down payment. Year 11, you don't have to do that. You can take that $50,000, still tighten your belt, still save, but now you can take that $50,000 and pay it toward taxes. On year 16, not only are you not acquiring another property, but one property is paid free and clear. That means that the rent you get in from that property is no longer earmarked for mortgages. That's surplus money. You can use that as well to pay the tax man. And the fourth benefit is the government allows you to depreciate your assets, show it as though it's losing value, and write that off against your income. Now, of course, we know they don't depreciate in value, but you're allowed to say that they do. You can't depreciate the whole property. You can only depreciate the buildings or improvements on the property, and there's a percentage that you can be allowed. But you can take that percentage and you can apply it and show it as a loss to reduce your tax. Now, it doesn't avoid tax, it defers tax. What happens if and when you ever sell, and I tell you don't sell, but at some point in time, you're going to have to pay recapture on the money you depreciated, because in actual fact, when the property is sold at market value, there wasn't any loss at all. But you can do these things to reduce the hit in terms of taxes. It's not simple. I'm sorry, it is simple. It's not easy, but it can be done. You have to tighten your belt. You have to plan for the tax hit, but there's huge, huge payoffs down the line. So make plans, plan for it. It will work. And if you follow this plan judiciously, you can solve the tax problem and you can enjoy huge benefits on retirement. Thanks so much for taking time to watch this video. Talk to you again next week.